Welcome everybody to the Physics of Investing. In today's video, we're going to be analyzing a stock called CleanSpark, ticker symbol CLSK. I've seen a lot of YouTube videos about this company recently, and I've also talked to several investors that have recommended that I look into this company. And so I decided, hey, why not? I'm going to look into the company and we're going to make a YouTube video about it. Now, if you don't know what CleanSpark does, CleanSpark is in the business of microgrid technology. Now, what is a microgrid? A microgrid is a set of resources and storage, which are batteries, used to provide a source of energy distributed from a central utility power. A microgrid can also disconnect to an island away from the traditional grid as economic or physical conditions dictate. Now, an example of a microgrid could be a customer building that has possibly solar panels, wind generators, their own regular, probably gas generators, microturbines, etc. It has all these different energy providers, and it's also connected to an electrical grid. Now, what the microgrid does is basically choose which energy sources it wants to pull from and which it doesn't. For example, on a really sunny day, maybe the microgrid is going to pull a lot of energy from the solar panels and less from the main grid, which would be saving the customer, which could be a school or a military installation, some money. So if we're looking at CleanSpark's business, we see that they provide advanced software and controls technology solutions to solve modern energy challenges. They have software solutions that provide end-to-end microgrid energy modeling, energy market communications, and energy management solutions. Their suite consists of intelligent energy monitoring and controls, intelligent microgrid design software, middleware communications protocols for the energy industry, energy system engineering, and software consulting services. So this company is trying to disrupt an industry that hasn't been disrupted in a long time. A lot of the same energy grid services that we use, we've been using for 50 plus years. What this company is trying to do is trying to get in that space and start to disrupt by creating software that helps customers, like I said, schools, military bases, etc., manage their own energy better in order to possibly save some money. Now, CleanSpark has several different platforms. They have the MVSO platform. This is an energy modeling software for microgrid design and sales. They have an M-Pulse platform, patented proprietary controls platform that enables integration and optimization of multiple energy sources. They have a Canvas, which is middleware used by grid operators and aggregators to administrate load shifting programs. And they have Played, middleware used by controls and IoT product companies to participate in load shifting programs. Now, CleanSpark, other than microgrids, they also have a gasification side of their business. But for that part of their business, we're just going to ignore it because it's so insignificant. And in fact, in their last 10K annual report, they said, as previously disclosed, we plan to continue to focus on our other product offerings as opposed to expending significant efforts on the gasifier side of the business. So when analyzing CleanSpark, we're going to mainly focus on this microgrid technology. So we talked about a little bit of what microgrid technology is and what a microgrid is. Now, how does the consumer use CleanSpark, or what's the benefit to someone using CleanSpark software or technology? Well, the platforms are designed to allow customers to design, build, and operate distributed energy systems and microgrids which efficiently manage energy generation assets, energy storage assets, and energy consumption assets. These strategies are generally targeted to operate distributed energy assets in a manner that provides resiliency and economic optimization and/or revenue generation through wholesale market activities. So the reason someone would subscribe to CleanSpark services or get some of their software would be basically to save money from their energy consumption. They're possibly consuming too much energy and they want to optimize it. So CleanSpark provides a solution for them to save money when it comes to energy consumption. Now, what is the total addressable market for this company, for a company that's disrupting a huge space such as the energy sector? Well, they have a rapidly expanding market, and the total microgrid capacity is expected to increase from 3.5 gigawatts to 20 gigawatts over the next decade. The global market for microgrids is expected to experience 28% compound annual growth rate from 2020 to 2029, nearing $40 billion. So this company has a massive total addressable market that's growing very quickly, a 28% growth rate over a decade is a ton of growth, which is always good. You always want to be in companies that have growing addressable markets or growing industries, and that way they can gain more market share, and even if they are keeping the same amount of market share, they're still getting more and more revenue over time. Now we're going to start to look into some of CleanSpark's financials. We're going to go over the statement of operations for the last couple of years. As you can see from the statement of operations, they had 100% revenue growth, which is really good. You always want to see that. But for some reason, only 14% of that revenue came from their software. Now, after we went over the business and after I looked through the annual report and the investor presentation, you would think that this is a software company, right? Their microgrid technology is all about the software that they use. But when we look at their statement of operations, we see that hardly any money comes from software. Almost all of it comes from the sales of goods instead of their service, software, and related revenues, which is interesting because you would think most of their money would be coming from their software. Now, if we go down to some of their expenses, we see that their professional fees and payroll expenses, if you add those up, it's over $13 million, which is more than they brought in revenue in 2020. Now, that's kind of scary because that means that just in expenses to their CEO, CFO, and their workers, they're spending more money than they brought in total. Not only is that alarming, but if we go down to the next line and we see product development, they've only put $163,000 into product development. When you think of a growth company and you think of someone trying to innovate and disrupt, you think lots of R&D spending, lots of research and development spending, lots of product development spending. And when we take a look at these numbers, we're not seeing that at all. We saw massive cuts in those. And I mean, just compared to 2019, look at how much they spent on product development. And then in 2020, they're just unloading some cash for their payroll and their professional fees, which is alarming. So I just want to point that out. Now, if we look at their net loss, they lost over 2 times their total revenue in 2020. 2 times the revenue. So whatever that 10 million, they lost $23 million bottom line, which is a lot of money to lose. And that's not that far off from what they lost in 2019. In 2019, they lost about the same. Now, they did have some great revenue growth between the years, but they're still losing just about the same amount of money, which you would think if they had massive revenue growth, maybe the loss would shrink, but it hasn't really shrunk. Now, if we look at the company's margins, we see that their software as a service and controls margin has an average margin of 90%, which is really good, but at the same time, the company's not making that much from their software. Their consulting and services revenue has an average margin of 90%, and their hardware revenue has an average margin of 15%, as well as a Bitcoin mining average margin of 80% plus, which we're going to look at later. So it looks like most of their revenue comes from their hardware, and that hardware only has a 15% margin, which is really low. We would really want to see more revenue coming in from that software segment because it has such a high margin. Now, if we look at the last quarter's balance sheet, we see nothing but good, honestly. They have 9x more total assets and total liabilities. They have 4.5x more total current assets and total current liabilities, and they have lots of cash. So the balance sheet looks clean. It looks good. Nothing really to worry about there. They have a great balance sheet. Now, if we go to the last quarter statements of operations, we're going to see, again, revenue grew by over 2 times, but at the same time, they also had massive losses yet again. Their net loss quarter over quarter grew just as quick as their revenue did. When we're looking at a company that's losing money, we want to see some sort of path to profitability. We want to see increasing revenue and decreasing net losses, or just increasing revenue and losses that aren't increasing by as much. Here we see the net loss growth is matching the revenue growth, so really there isn't a path to profitability for this company as of myself looking at these financials. And that's what you really want to see when you're looking at a company that's losing money. Now, CleanSpark also recently made an acquisition of the ATL data centers, which could help out their business a little bit. It's a Bitcoin mining center. And in their investor presentation, they said that this could bring in roughly 80% margins or $1.5 million per month, and $1.5 million per month. Now, this is a little bit far-fetched in my opinion because there's a lot of assumptions being made here. Now, to make these calculations, they used the Bitcoin price of a 5-day moving average of around $34,000. Now, I think you just can't do it. I think it's just not fair because Bitcoin, the price literally has regularly and consistently dropped by 10% or more in one day. So just to use a 5-day moving average, I feel like isn't exactly fair. It's pretty far-fetched. And that's not the only thing that affects the profitability of these mining centers, as well as the revenue that they're going to bring in. The block reward, which is how many Bitcoins are awarded after a miner finds a solution, that affects how much revenue and how high the margin is for these miners. And that gets halved every 4 years. I think that was halved most recently in 2020. The mining difficulty also affects this margin and the revenue that these miners are going to bring in. Now that varies depending on the number of miners out in the entire Bitcoin system, which is something completely uncontrolled by CleanSpark. And like I said, Bitcoin's price is very volatile. It'll drop by 10% or go up by 10% in a single day. So the ATL data centers could be a good addition to the company, but the way I see it, it's heavily speculative. You just don't have any clue. Just alone with the Bitcoin price, how that fluctuates regularly makes that whole part of the business, that whole acquisition, pretty speculative. I'm not saying it couldn't make a ton of money, but I'm just saying if I were to focus on this business and I were to look at it, I'd be looking at their microgrid technology, which already isn't very appealing to me in terms of their net losses, as well as in terms of how much they're paying their employees versus how much they're putting to product development, and et cetera. Now, if we look at the company's valuation, they only have an $800 million market cap. Now, this is a really small company. So you could assume, okay, maybe there's a ton of growth, and which there is because we saw how the industry is growing. But you just got to think about how much of that industry can they capture, and what's their profitability going to look like. If we look at the price to sales of this company, they have a 35 price to sales, which is absolutely crazy. Now, considering 100% revenue growth, maybe next year if they keep this up, it'll cut down to 18 and get cut so forth. But that requires them to execute with this 100% plus revenue growth. And that has nothing to do with profitability, though. They have a 35 price to sales right now, but they're not profitable. They're not even close to being profitable. They're losing a ton of money, which is something to keep in mind. I mean, bottom line, all that matters in a company is how much money they make. How in the long run, how much do they make bottom line in the long run? This company's not making anything, and it's not even looking like they're getting to a place where they're going to make something in the future. So to summarize, this company has massive revenue growth and is in an industry that's growing very fast, which is really good, but they're losing an insane amount of money every year and every quarter, which is disturbing to me, and I don't see any path to profitability for this company. They're barely bringing in any revenue from their software, which you would think would be the main segment of their business based on how their investor presentation is laid out, how their 10K is laid out, and how the company as a whole is presented. And they're paying their employees a ton of money. Like, I'm sure they're paying their CEO way too much money, and they're putting very little into product development, which is not good at all. Now, they're trading at a massive premium right now of a 35 price to sales. So when I look at all this information, I'm just not interested in this company, especially right now. There's too much going on that's wrong with it. There is some great stuff, which is the industry that they're in and their technology that they have, but they're not really making very much money from their technology. And from what I've seen, there's just a lot of red flags going off. So if you're in this company and you like it for the long run, maybe you'll 2x, 3x your money. But when I look at this company, it's just not for me. I just see too much speculation, and I will not be partaking in a position. If I knew someone that was in it and I had to recommend to them, I'd probably say sell, because the stock's been on an absolute tear, so most likely you've made some good money. But from a long run perspective, I just don't see this company reaching profitability anytime in the future. And if we hit a stock market correction or a crash or something similar, stocks that don't make money, that aren't profitable, are going to hit the hardest. And so this is just a no for me. It's just not for me. If it's for you, that's great. But that's about it. And I hope everybody has a great day.